Hey, everybody. Good to see everyone. So thank you for joining. It is our May Lunch and Learn. We're going to be talking about everything condo. I'm just going to take 2 minutes and I'm going to let all the ladies know. Men, you're also welcome to join. I don't know if you'll want to, but you're more than welcome to. So tomorrow is the first time in 3 years that we're able to do ladies' night. So very exciting. I feel like it's kind of like, a big first with that, not being able to do it with COVID. So it's in Uptown Montclair tomorrow from 6 to 9. I have been pushing out the registration link. If anybody else needs it, let me know. Just give me a text and I'll put my text number in the chat. Basically, we're having all the businesses are staying open late. They're running specials, and I'm co-chairing it with Rhea, the art gallery owner, and Wendy from the general store. It's part of the Upper Montclair Business Association. We're going to have a DJ. We're going to have a mixologist. So you have to register. You have to go to the registration table to sign in. You'll be receiving tomorrow a link with a map that shows all the businesses that are participating. I have to tell you guys, the raffles, like the donations, are insane. Like Williams-Sonoma alone donated $500 worth of products. So make sure everyone gets 2 drink tickets and everyone gets 6 raffle tickets free of charge. And then we'll be asking people, if they could, to make any kind of donation to Dress for Success. That is our charity of choice since it's the Ladies' Night Out. And they actually will be here and answering questions and talking about what they do. So it should be a great night. If you want extra drink tickets, come see me in the office. I'll give you extra drink tickets. Don't tell anyone. Next slide. So today's going to be condos. So for those, I know I'm looking down the list. We have a couple people that have joined for the first time. So thank you for joining. So the other ones that are always on, just bear with me for 1 minute. So I always include this slide so people know, Baret's team, we're the #1 team in the country for loanDepot. We've helped over 15,000 clients and been doing this a long time. Baret's #9 in the country out of over 300,000 lenders. And I say you guys are very fortunate because we just happen to be here and we're local. So that's about the team. Next slide. I always include this. We've been growing. So here are all the members with the loan officers. Most of them are on the call today. And Mike is our new sales manager, and wonderful having him on board. So any questions about our team, those are the loan officers.
Okay, and to get started, Baret, if you want to introduce yourself.
Hey guys, I'm Baret Kechian. I'm the manager for the team. Condos are kind of like my thing. It's the niche that got us to where we are today. I always say, trained monkey could probably do a single family conforming loan, but condos are for the big boy and big girl table, because that's not easy. But if you can do those, then, in an area like ours, your growth is easy because people move out of condos all the time too. So it's kept us busy for years and years, regardless of the market. So I'll hopefully share some things with you guys today that will help you as real estate agents. I even have a lot of my team here because everybody can use the training that might help you guys when you're listing a condo and also when you're taking buyers there so you don't get any shocks. Go on to the next slide. We have, Mike.
Myself.
Yourself.
So those of you that don't know me, I just joined Baret's team earlier this year. Prior to that, I was with a couple other mortgage companies, going over the past 10 years, experience in operation, and most recently in sales. I was supporting one of the top producers at NJ Lenders. So I bring some more experience from other teams. And I can say firsthand that the way they handle loans in general, and especially condos on this team is next level. It's definitely better than anything I've ever seen before at other companies. And then just some other things about me: big sports fan, like boating, played lacrosse in college at Catholic University. I'm from the Philadelphia area, so Eagles, Flyers, Sixers. And like Baret, I also like wine.
Yeah, wine becomes a common theme in our office.
And we don't hold the Philly thing against you. We like you anyway.
Thanks.
So I'll introduce Heather, because Heather has been with us for a long time, and she is the reason why I think our condo team works so well, along with Kiara and Tatiana. But we figured we'd just have Heather here today. we kind of decided like a while back that we can't just have a processor gathering condo documents. I think that's the biggest flaw that's in the industry right now, why condos get screwed up all the time. You leave it in the hands of a person that's also trying to get a mortgage commitment, also trying to communicate with the client, trying to set closing dates. And what happens is they forget to order the condo questionnaire, or they don't follow up on it because they're too busy, or they get something on it and have no idea what they're looking at. And so when that happens, and condos are everything, like, you know, for the realtors here that are in the suburbs, townhouses are condos too. So all those major complexes, they have litigations, they have townhouse style condos and everything. And Heather is like what keeps us going. So I can literally, somebody can send me a condo, and if I don't know it, I can send a quick email to Heather. She has the ability to search everything through the whole company, actually, because now she's also a condo underwriter. And so that's been a huge help. Heather, give a quick introduction if you don't mind.
Hi, I'm Heather. I've been with Baret's team for almost 6 years now. I literally knew nothing about mortgages coming into the business. So I learned everything from Baret and being a part of the team. I'm a proud mother of two. I said I love and hate pasta. I'm sure a lot of people do. I have beautiful dogs. I graduated from Temple. I really, really enjoy my job because I started with talking to all our management companies and insurance companies that we work with on a regular basis. So Baret's main idea, obviously, is to form relationships, and we absolutely do that. So if we need something, they're right on top of it to help us out, and I really enjoy working for this team.
Heather, see if you could turn your volume up a bit. We weren't hearing you that great, at least I wasn't, but for the next time. All right, yeah, we can get started.
Okay. Yep. And it's just before we get started, if anybody has any questions throughout this whole lunch and learn, you know, ask questions. We want to make it as interactive as possible. So we will be monitoring the chat throughout and trying to get to all the questions as soon as we can.
Yeah, so Mike, if there's a question that gets asked, just jump in and
Yep, I'll bring it right up.
especially if it's in context. You know, so condo warrantability, everybody sees it, you know, what's a warrantable condo, whatever. It's basically a condo complex that lenders look at and approve. So when you're doing a condo, you're not only approving the human being for the actual loan, you're also approving the complex, and you have to approve the complex to meet certain guidelines. Now, Fannie Mae and Freddie Mac have their own guidelines. And in our world, we can basically use Fannie and Freddie mostly interchangeably. In some cases, you might have a client that's a risk level that doesn't fit Freddie, only fits Fannie. In that case, they have to fit the Fannie Mae condo model. The stuff that's different than that would be anything jumbo. So jumbo would be anything above 647,300. Those loans, which we are doing all the time, the reason being is the rates are better. So we're trying to fit every client into that. Those guidelines are slightly different. Some of them do go right by the Fannie guidelines, and they're great. And they let us do all the same stuff. Some of them don't. So you just have to know. And they do differ lender to lender. Like you will have certain banks out there that have separate condo guidelines and don't follow any of the Fannie Freddie guides. They don't care about anything. They have occupancy requirements, whereas others don't. They may have specific insurance requirements. Like as an example, Chase. Chase has some of the worst flood insurance requirements in the entire industry. We've picked up more business from Chase fallout than probably any other bank on condo. And the reason is they want the flood insurance for the building to match up with the homeowner's insurance for the building. And the problem is you're not going to get that because it's two separate companies that are evaluating the building. So one might say that it costs $2 million to build it. Another one might say it costs $2.5 million. Well, Fannie Mae, as long as the one that says $2 million is the flood, they'll let you do $2 million because they're saying, hey, they're saying it takes $2 million. They got $2 million in coverage. We're good to go. Chase says, nope, we want $2. So they want $2.5 million, and it blows up buildings in Hoboken and Jersey City all the time specifically. So that's where like an example of a bank having their own overlay that is not Fannie Mae or Freddie Mac. So just something to think about. So we can go to the next one.
I think the next one's just part of that one.
Yep, we can go right to the next one. Yep. All right, so these are the big reviews, right? So you definitely want lenders that know how to do this, when you can use limited review versus full review. They are pretty important. As the description kind of says, limited is very easy and full review is a lot more in depth, right? So when do we use them? So in limited review, there's no budget review. That's a big one because there's a lot of buildings that just don't do the whole reserves thing, right? Like they don't keep the reserves, you know, especially in Hudson, or you see a lot of buildings, 5 or 6 units, and they just kind of run the thing like by the seat of their pants, right? Like they'll, oh yeah, we have this much in expenses. We're just going to collect this much in maintenance fees and that's it. If anything comes up, we'll all chip in. Everybody agrees, they're happy. So there's nothing wrong with the building technically, but it doesn't meet Fannie Mae requirements. for a full review. So if that wasn't a limited review, you've got a problem on your hands. You won't be able to lend there, and you'll have to come up with a different solution. We don't check for delinquent dues. So if you happen to have a building that is running like right above that 15% mark on delinquencies, and delinquencies are defined by anything over 60 days. So if somebody's 2 months behind their HOA dues, they're considered delinquent in the world of condo. When did this come up? Well, last year it came up a little bit, like people during COVID and stuff were trying to kind of say, oh, I don't have to pay rent. I don't have to pay dues. I don't have to do anything because it's COVID time. And so you were seeing a little bit more of it. So limited review bypasses that too. And people call me all the time. I have a building, it's established. My buyer has 20%, but the building has 2 owners and 8 renters. What do I do? You do absolutely nothing. It'll qualify with no problem as long as it's a conventional loan. Limited reviews don't care, which is awesome. They are just for established condos. They're not for brand new developments, and they're not for ones that haven't been turned over to the association. So if the current developer or something is in process of selling, even if he sold 80% of them, it's not good enough. It's got to be 90% fully sold and closed, and has to be turned over to the association. So something basically, think of a limited review eligibility as something that's been around for a while. And limited review works for jumbo too, a lot of time, just not always. So again, this is where condo lender literally looks at the condo first and makes sure whatever program you're talking to the client about matches up. Otherwise, you may end up quoting something and the condo doesn't match up. And then next thing you know, you're scrambling. And if it happens last minute because you missed something, it's a real problem. And I hate to say it, we see it all the time, even with the local guys, the guys that supposedly know everything. They know they're local. They tout about their local. We get a lot of fallout from there too, because they don't check. They're either sloppy, they don't take the time. And next thing you know, somebody calls and says, blah, blah person screwed up this condo. They can't do it. They're telling us it's going to be a different program, whatever. The only reason that would ever happen is they didn't check up front on the specific characteristics of the condo, or they didn't have it. Heather, I miss anything?
No, I thought that was great.
That's it, right? That sums up limited review pretty easily.
Yeah.
Go on to full review. That's the next one. So full review is the biggest differences between the two. The budget review, that's a big one, right? So we all get nervous about that. So when we know we have a full review and we don't have a budget in hand, it's as if you don't have the client's pay stubs in hand. It's the same thing. It can kill your deal as easily as the pay stubs coming in with less income. It's as if you have a self-employed client, you never check their tax return. So equally destructive to the file is if the budget comes in and there's no reserves, it becomes a real problem. The other thing we have to check, and this is where some of the, and you're going to see later when I show you kind of some of the things you can ask, we have that summary and you guys will get all this. So there's nothing to write down. So don't worry. You'll get a copy of this stuff so you can look at it and kind of, put a cheat sheet on your phone in your notes section so you know what to ask when you're picking up a listing, and also some things you might be able to at least check or ask up front. And then the big one is single entity ownership. This is one in our office. We kind of just make it a rule. If you're going to do a condo and it's an odd address that you haven't done anything in, there's not many, but there are some. If you have an 8-unit building in Hoboken and nothing is traded recently, you would certainly not know anything about it unless you looked it up. So we look it up on tax records, which is the same thing you should do, and just see if there's any multiple owners in the building. So if the same guy owns 4 out of 8, as we had yesterday, that's not going to work. So that's 50% ownership by one entity. It won't work. The most you can have is 20% in a bigger building defined by over 20 units. 25% Freddie Mac allows, which is great. So we use that to our advantage sometimes. It's just an oddity, but most programs are 20%. So if you have a 100-unit building, one person can't own more than 20. As long as they own 18, you're good, but 20 becomes a problem. And then on a smaller building, like your typical 20-unit and below building, they can own up to 2. So you can have 2 units owned by one entity, max. They own 3, again, we have a problem. We could ask for a variance from Fannie Mae, but Heather, I think you would say that's not easy. And I don't think we get very many of them because they kind of changed their guidelines now to match up. And we just don't see too many variances coming through anymore. Is that fair to say?
I would definitely agree with that. Not as much as we used to do.
Yeah, hard to do. Fannie doesn't want you to ask them for anything. No favors, nothing variance, not they're basically me, especially now, which we'll discuss later why they tightened up even more. They don't want to hear it. So hopefully you meet the guides. There are workarounds. We had one the other day where, we received it. A lender turned it down because the single entity owned 14 out of 38 units. Sounds bad at the outset, except I knew the building and I know the builder and I know the guy who converted it. And it turns out like the reason they have those is because they're rent protected tenants. They can't be kicked out. They're protected. So those units, Fannie Mae deducts from the total, and then you still have a viable loan. But if that lender doesn't know that, that deal's dead. We actually offered the client an option to save the deal if they want to. Now he's checking on rates and things like that. But otherwise, at least we know we can do the condo, and we would have been able to do it from day one. But here's an example where they got turned down by another bank just simply because they're not familiar with it. That's all it is. All right, we can go on to the next one. All right, so the big one on full review. So every single new construction complex is full review. They will check everything. Now, what can come up in new construction that can cause you a problem? The budget. You can look at that from day one. There's no reason we can't get a hold of a budget on new construction from day one. So that should never be an issue once you start the loan. The only other thing that comes up on full review for new construction is pre-sale. You need to have a certain amount of units under contract or sold to primary residences. So investors don't count, primary only. So 20 unit building. In fact, I'll give the example. We had one on 5th Street not too long ago in Jersey City, 18 unit building. We, as a lender, will actually allow some pre-sale waiver. We will not require the 50%, but most lenders, most banks will absolutely hold you to 50%. They want to see half the building either closed or under contract to people that are going to occupy the residence or use it as a second home. So that's a key critical thing that'll come up. When does it hurt you? Well, if a building just wants to start closing things right away because they went to market as they were done with it, you can't close. You got to wait, right? So meanwhile, the developer is like, hey, let's start closing loans. Like we're ready. Like we have our CO, we're ready to move, but you don't have enough sales, you're going to have a problem. Not all programs will allow that pre-sale waiver, but our conventional loans will. And so will our jumbo product that we have, our internal one. So would you get like necessarily the best rates with it? Maybe not the best, but you can close if you really need to close. And if you really are, at the end of a lease or something, you can close. This week, we broke the entire rule book because we ended up closing some deals in a building that was close to their CO, but unfortunately didn't have their CO yet. But we literally had clients coming due on their freaking interest rate. And they were going to go from 3.25% where they were locked to like 5.5% because they were completely out of extensions. So we knew we were really close on the CO. I think I may have used every favor I will ever get from loanDepot on this one. And they allowed me to close the first 5 or 6 people that were literally going to lose their rates and go up 2.25%. They allowed us to close them without the CO, held a couple of bucks in escrow. And then we did find out like 5 minutes ago that I saw the CO approval. So soon we should be getting the certificates any day now. So they did that purely on trust, obviously, but that's where I think, again, having a condo lender helps, having a person that knows what they're doing helps, because we can pull those favors. Heather, you can joke about this for a little. Is there anything that we haven't gotten that we really tried for? Maybe 1 or 2 things we just couldn't get over the hump on some litigation stuff, but almost always we've gotten most of them, right?
It's like magic.
Yeah. Yeah. We just kind of bully our way to those reviews and just get them done. But at the same time, we fully believe that they're safe for our buyers. If they weren't safe, if we didn't believe in the buildings, if we didn't believe that they were going to be okay going forward or that nothing was going to hurt the buyer, I would never do it. So if there was a building that truly has like problems, I'm not lending on it. I don't care if I can get around the litigation. But if I know the building's good, oh, sorry, my dog barking. Hang on. All right. Sorry. Quick Zoom delay, dog delay. I'm in my short house today. I had to do some things, not here for fun. But otherwise, yeah, that, like, in terms of like just being able to, do that, we will only do it if we know our buyers are safe. So it's got to be buildings that we truly believe in. We see their marketability. We see that they're still selling these things at top dollar, and we'll fight for it. We're good to the next one.
We had a couple questions here.
Yeah,
Real quick.
please. Shoot.
So Danielle asked, so that means that multiple units have to close on the same day?
They don't. They could just be under contract, Danielle. So like they can, as long as we can document with the seller, the attorney, or whoever the sales office is, that they have the right amount of contracts that are bona fide contracts, which is stuff that's out of attorney review, and we get that in writing, the first one we could be the first one to close, and then the next ones can close as they go. So under contract is as good as sold in our world. But it's always fun though. Like you're asking them, hey, how many units do you have under contract to owners? And they're like, I don't know if they're going to live there or rent it. I'm like, you got to know. That's what you got to know in order for us to be able to do this. So if you want to tell me that they're owners in your best case opinion, that's great. But I need somebody to tell me that. I can't just assume it. And so then, it's always a massage that we have to do with the developer or whoever the representative is. Heather, is that fair to say?
Absolutely. That's why
Yeah, constant back and forth.
developer over and over again.
Yeah.
And then one other
Danielle
similar
Zavala's question about FHA spot approvals. It's not technically a spot approval, but it's as similar as it gets. It's a little different in that it is a single loan approval for FHA for established projects. There's a checklist of about 7 or 8 things. It's definitely not as easy as a spot approval was. Spot approval, you got a questionnaire. I don't even know if you had to get a budget back then. It's been a while, but now you have to get like pretty much everything that you would normally get an FHA approval, but they let the lender do it instead of having to send it to HUD. So you're still getting master deed, bylaws, the budget, minutes from the meetings for the last 6 months, all that crap, basically, I'll say. So you have to have a management company that is willing to provide it all and not going to get annoyed because we're going to ask them some questions. So as long as they're cool, it's doable. We actually got, if anybody knows the complex Harmon Cove in Secaucus, it's a friggin' massive complex. And we got that one approved for one of the real estate agent's sisters because, we took it on. I try not to take on too many of those because they are a friggin' pain in the butt. And what happens is you can't order your appraisal until the condo is already fully approved. They won't give you a case number without it. So like we have to go through getting everything, get it all approved, then order an appraisal. So it really like semantically causes a huge headache for realtors because they're like, the seller's asking like, why haven't you ordered an appraisal yet? And we physically can't because we don't have a case number from FHA because the condo's not eligible. So it's a little bit of a, thing that we have to go through, but it's not impossible. They are doable.
And there was one other question. What's the longest rate lock someone can do and how many extensions for what length of time?
So we can either do a long-term lock. We do have a long-term lock program that goes all the way up to 360 days. So that one you can do up front from day one. But let's say you weren't anticipating it closing late and you did a normal 60-day lock. You can extend up to another 60 days. So in those cases, we had done either 60-day locks or 45-day locks, anticipating it to close because it's severely delayed in that building I mentioned earlier. Like we're behind by 3 months from what they told me was the guaranteed date, so that's how far we are. And so 60 days is norm, and then we do another 60 beyond it. But we have the ability from day one to do a longer lock. So we could just do a 6-month lock, a 12-month. But when you do a long-term lock, you're not getting that day's rate. You're getting a cap from that day's rate. So if the rates are 5, you're getting a cap at maybe like 5.3. So it'll be no worse than 5.3. It could be better than 5.3, but it'll be no worse. And you have 6 months of protection and blah, blah, blah. So they are there and we do use them a lot for our new construction stuff. But that's the general. The general lock terms are 60 days and then you have up to 60 days of extensions, which in a lot of cases, people choose that option and we just kind of build in that cost of extension up front and we know how much that is. And they go in knowing that, so it's not a surprise.
Okay. Moving on.
All right, so this is the big one, right? This is what you guys should be checking on every file. This is what matters for the agents more than anything. I can probably do this without even you going to the next slide, but all right. So the big one, litigation. Just ask, if it's a small building, 4 or 5 units in Hoboken, it's not going to matter. Nobody has litigation on those. But if it's anything with, I can tell you the ones that are the biggest culprits. Large buildings on the Gold Coast, Edgewater, West New York, there's a bunch of them. We know most of them. So if you email me or text me and say, hey, does this one have litigation? I'll be able to tell you unless something happened very recently. But we had one like that. So we had 1200 Avenue at Port Imperial, right in Edgewater. I asked Heather the other day, I said, hey, or somebody asked Heather, hey, is this their litigation here? She quickly looked it up and said, nope, we did one last year. There was no litigation, but I had heard about it. Turns out the litigation started in January. Our last deal there was in September. You wouldn't know any other way unless somebody told you. So that's important. So for you guys, just ask about litigation, anything that you should know about. This way, the selling agent should know that or should be able to get that information from their seller pretty easily. And if you are the selling agent, certainly ask your seller if they've seen any communication going back and forth on any sort of litigation. Management information is a gimme. Have that handy up front, no questions asked, have the contact. And so this way you have their email address for quick access so we can get questionnaires quicker. The current approved budget. There's really no reason not to get this. even if they're eligible for limited review, you don't know what buyer you're going to get, and you have no idea what bank they're going to use. So if they don't use somebody easy like us, and they do go somewhere where a budget is required, have it. And then what you're looking for on the budget, we'll pull up in a second, is really that reserve allocation. So what they want to see, they don't care how much money they have in reserves now. You can have no reserves, it doesn't matter. They want to see that in 2022, whatever amount of money you think you're going to spend for the year and whatever amount of money you're collecting for the year, there's at least 10% left over as an excess. $100,000 in expenses, they want to see you collect around 110. That 10,000 being that reserve that they want to see in the account. They don't want you down to the nub on expenses. And it makes sense, right? Like they want to have some, budgets never work perfectly. People budget all the time and they go over budget all the time. So they want to have that 10% to know that in the future, there's money accumulating somewhere. Is it 100% real? No, it's mostly bullshit. Like people budget all the time for reserves and they never collect them, but that's what they want to see. That's what we're looking for. And most of the management companies know it. So anything professionally managed usually is okay. But again, case by case, certainly ask about it. Commercial space, you'll obviously see it in the building. If your building happens to have commercial space, just check on the percentage of the space. If you see 4 floors and you see the entire bottom floor is taken up by a office, you should probably ask in case the office jets out further or something like that. 35% is your maximum. So that's easy. 35% is the maximum you can have in commercial space pretty much across the board. So that's a big one. And then the single entity ownership we talked about earlier, just look up your building. If it's a townhouse complex and you can't look up a specific address like you can in a high rise, then just ask. Have them call their management and say, hey, is there anybody in our complex that happens to own more than 20% of the units? They should get a very quick no. In most places that have sold out, you're not getting it. The places we're seeing is more urban areas, North Bergen, Union City. Somebody converted an 8-unit building. They sold 4. They kept tenants in the other 4 because they didn't want to sell those and they wanted to keep them. And they didn't realize they screwed it up for everybody else. We had some buildings back in 2008 when the crash happened. They were literally in that selling process. They sold what they could, rented the rest so they don't lose their shirt, and then have not been able to sell them since because they have tenants in there and they just kind of kept it that way. There's one in Union City called the Altessa that has that. There's like 50% owned by a single entity. There's one in Bergen Lafayette, which is on 300 Communipod, and I'm forgetting the freaking name of it, but that one has the same thing where the sponsor owns a bunch of units in there, the foundry, excuse me. So yeah, so they own a bunch of there. So those are examples of ones that's really what happened. And here's the big one, assessments. We used to not give a crap about assessments. It was like assessments, all right, well, the seller's going to cover the cost, great. Now, and we'll see in a second why, they want to know about the assessments and what they're there for. Like, what are the assessments for? So when you're asking about litigation, say, hey, do you have any litigation in the building? Any assessments that they've told you about that they're going to be collecting? And then why? Well, the reason they're collecting assessments is because our roof is collapsing and there's a leak coming through. That's a problem. If it's, we're redoing this, we're just doing an upgrade on the elevator and we decided we don't want to dip into reserves, cool. As long as everything's functional, there's no safety issues, there's no structural issues, we're fine. So things like that are critical. These are the questions I would, when you get this, just pop these into your phone under notes and ask them. They're really easy questions. On the buy side, you can see a lot of these things. You can certainly check the single entity ownership or very easily text someone on our team and we'll tell you. Because we can look up almost every single condo in Hoboken, because between us and the loan officers that work for us, I'm guessing we've done something in almost every single complex and many in some. So we'll be able to tell you right up front. All right, next. Any other questions that we want to jump into in the middle?
No other questions right now.
Cool. You have a budget you can put up by any chance real quick? Or is that later?
I don't think we have one just yet. I had the questionnaire.
I sent an email of one to you earlier. If you can, it's fine. So
Okay.
Obviously everybody knows about the Surfside, Florida tragedy. That's kind of what I was mentioning about like what changed things. So in November, because of this terrible tragedy, that basically was just a building being completely negligent, not, doing anything about a major issue that they were warned about numerous times. You saw a horrendous thing happen, which is like the fear of everyone, like the building freaking collapses, right? Terrible, terrible tragedy. Fannie Mae probably overreacted. This could have been an isolated incident. We haven't seen it since, but things do happen. And so because of that, they tightened up tremendously. So they now are asking numerous additional questions that we have to, as a lender, make sure. Where'd that hurt us? Well, it hurt us on the buildings that we had previously had approved that had litigation that we felt comfortable with what's going on. Heather, do you want to just jump in real quick and kind of go over some of the things they ask now, like that you have to find out because of what happened in Florida and some of the changes real quick?
Yeah, can everybody hear me? Oh, I know I'm a little staticky.
You're right.
Yes, we can.
Okay, good. So the main things that they're looking for are structural integrity questions. So they're going to ask, has there been an engineer report in the last 5 years? They're not looking for reserve studies. They're looking for a separate inspection, which is what we really need to say when we're asking for them, because they want to make sure, some of these older buildings will have that done every 5 years, just as a precaution. So if they do, we need to have that, and we need to know if anybody had to vacate for any kind of reason for repairs due to structural integrity, and then that a final CO was then issued again for unit owners to occupy again. So those are the three main things that they're going to ask. And just like Baret had said before, when he was talking about special assessments, that goes with that as well. So if they had a special assessment to do repairs, they're going to look into that too for an engineer report. Sometimes they won't give it to you. So it's really important to have a relationship with the management company and let them know up front that we do need these questions answered. We cannot submit any questionnaires without them. They won't be considered. So we do get some feedback on that, but in the end, these three questions are the most important to be answered by management.
Yeah, I mean, the key is that some buildings will not share it. They actually have told us, yes, we've had an engineer report. So something's up. You wouldn't just get that out of nowhere. It's not for a reserve study, but they won't share it. They'll say like, oh, we'll show it to the buyer if they want to come to our office and look at it, which doesn't help us at all. So there's been a lot of cases where we've just had to get as much info as we can and then literally make a business decision. And there's a lot of lenders not willing to make that. The reason loanDepot can is, number one, we have some variances with Fannie and Freddie that we can use. That helps. Number two, we're big, so we can hold on to loans. So we can stick a loan on a balance sheet if we had to. So maybe make that exception for the entire company, but they certainly do for us, I think, more than anybody. And it helps, here and there, you might be able to pull something off. We just did one in Four Seasons, a retirement community in kind of that West Patterson area. Forget the exact town it was in. And there is literally no reason that there was nothing warrantable about the condo technically, because they wouldn't give us any information. Now there was nobody got moved out, nobody had to evacuate, but they absolutely had a litigation and it was absolutely for defects. We got none of the info we asked for. They were as uncooperative as you can possibly get. And we literally just made a business decision for the sake of our client, who was our previous client, who's buying the place for his mom, just to friggin' close it. And there was, like I said, there was no good reason to do it, other than we didn't think the place was coming apart. The marketability was good from what you can tell, the values were still good. And we just literally just made a judgment call. And sometimes that's what you have to do. You don't get what you want. Those engineer reports and stuff that are being asked now have caused just annoying things, delays, and just extra work for Heather, who thank God has good relationships with many of the management companies and attorneys, and will get a lot more documentation than I thought she could, because they'll give it to her just based on a relationship, but it is key. So, yep, we can go to the next one, Mike.
Okay, I think the next one's just questions, but I do have the budget here.
Oh, cool. Yeah. So if you want to just share a budget, I'll just show you guys what I mean, with the 10% reserved. So this is the Park Hamilton. I just got this one from 2021 and the 2022. If you just look at the revenue line up top, the 784,000 in 2022, that means that's how much money they're collecting. And then sometimes they'll do it where they'll just go right down the line with all their expenses, and at the end they'll have a reserve allocation. In this case, they actually have it right on the revenue line. If you go to that line on the bottom, 6955, right on the revenue line, it says $100,000 in reserve contribution. So if you take 100,000, 784 in maintenance, that's over 10%, we're good to go. If that line item wasn't so high and it was only 60,000, you wouldn't be good to go. So if they had so many expenses that they couldn't put that 100,000 in, you'd have a problem. So that's a case of one that works, but that's what we're looking for. We mistakenly all the time get people saying, oh, they have 2 million in reserves. That's great. If they don't collect anymore going forward, that'll still be a problem unless they can give us a reserve study that says they don't have to collect anymore because the repairs are good to go. Very rarely do they have one of those. So the easiest way to get around it is this. We do have some workarounds. There are times when we will be able to, if it's like 9.2%, we'll make it, and we have some things we can subtract out to kind of finagle that 10%, but 10% is ideal. So this is a great building.
Okay, did you want to show the questionnaires also real quick?
I'll just show you guys what a questionnaire looks like. And we also sent it out, so you got a copy of what they're asking for. This
is limited.
I think is the limited, right, guys? Just so.
Yeah, this is limited.
Yep, this is limited. So if you notice on this is a pretty short questionnaire. There's not a lot on it. The top part is just how many units, how many phases, all that stuff. We're asking those questions on the building structural integrity. So in the middle, you'll see that that's all the stuff that was precipitated in November. Project characteristics. So all we're looking for is things that would make it ineligible. So, if you see it says, does any single entity own greater than 20% of the units? That's important. That's one that would be a problem. Does the HOA have a lien priority greater than 6 months? That answer is almost always no. That means basically like if somebody gets foreclosed, how long do they have to keep paying? And usually it's the max is 6 months. I think the state is 6 months in New Jersey anyway. So so a couple of those things. Is it a hotel, condo, housekeeping services and things like that? We really don't have that anywhere near us in North Jersey. The only time you see that stuff is if you get down to like Wildwood and those areas where hotels were actually converted to condos. You see it in some other states too, where hotels were converted to condos and they still offer like hotel type services. Those types of loans need special financing. You see it in the ski resorts at sometimes too, where they do have like a rental desk and all that stuff. So like if there's a concierge, it's probably not great, but in reality, it's mostly like this stuff, like no rent desk and things like that. The key things to ask for is exactly what I asked you for earlier. And if you go down, Mike, it'll show the end of the questionnaire, which shouldn't be a lot. Yep, insurance, and that's it. Like it's literally that short. That's, no litigation, nobody owns more than 20%, and you're probably good to go. Like there's not a whole lot more that could come up that would hurt you on a limited review. So that's anyone buying a home, established, they have 10% down, and they can do it on a conventional loan. Jumbo, some programs will allow it, some won't, but we will always have access to them. So worst case, if I see that a building can only meet guidelines for limited, I'll make sure I put them into a jumbo program that accepts limited. So this way, like we'll quote those rates, we'll explain to the client why, and we'll explain to them that they might not be able to get, 4.5, but they can get 4.75, but they're going to be able to close, which is the key thing. So the full review, if you go to the next one,
Here's a full one.
A lot longer. Is that it?
Yep.
Yeah, go to the next page. Still going? Yeah, so there you go. So there's a lot more questions on that one. On the full review, we do ask owner and renter, breakdowns and things like that, because in some cases it could matter. When you're buying a rental property, let's say, and you're only doing, say, 20% down, that could come into play. Some of the jumbo programs, they can come into play. So we do ask a lot more on a full review. So we'll let you know, like kind of almost up front what you need, but that's it's a key parameter of it. I think that's
okay. I think that's everything.
All this so that if you ever want to get one filled out and you're able to get one for free, great. Send them over. I'll look at it in 2 seconds and tell you if it's good. This way, like you won't have to like wonder if your seller is willing to get one filled out. If your seller wants to get, because they're worried about something, if your seller wants to get one filled out and just pay whatever the cost is, generally, and they're anywhere from $75 to $250, just to make sure for themselves that everything's good. Do it, like send it over. Again, it'll take us all 2 minutes to look at it and tell you if there's a problem. So, that'll be easy for you guys. I see some.
One other question come in.
Yep, we're gonna do Q&A the rest of the way. So pretty much shoot if you have any questions on anything that specific buildings or whatever. Feel free.
I have a question. Can I answer?
Yep.
Can I ask actually? Okay, so what are the rates right now for, let's say, a really good solid buyer for a 11 units, purchase price 5.5 million or something like that, 6 million, somewhere in that range? What would you say like the rates are right now for an A buyer for that source, has other investments, good qualify, right? They have other. What would you say like the rates are right now for a commercial loan like that?
That's a great question, man. We don't do commercial lending, so I'm probably the wrong guy to ask on that.
Okay.
From what I've heard, they're usually doing mostly like 525 type loans. So 5 years of fixed rate protection. And then after that, it adjusts every 5 years. I've heard rates in the 4s for stuff like that. But to be honest, I'm the wrong guy to ask on that. I hate not being able to answer a question, but we don't do commercial.
If you have any commercial guys, if you don't mind, after this call, just if you can
Yeah,
recommend, that'd be great.
Ed actually has one, and I'll have him hook you up with him so you can get the answers on that. So after the meeting, I'll have him send you an email with it. That's who we refer, for some of the commercial stuff.
Okay, and then one more thing. Can you actually send this out, Liza? I don't know who's getting this information. Can we have a copy of those kind of questionnaires?
Oh yeah, definitely. Yeah, we're going to send the whole deck out, and at the same time, like the questionnaires will be included too. Yep.
And I have one last question. When does, I've been seeing this now. We're having some deals blow up out of nowhere, like literally for no reason that I could see. Like you pass inspection, I'm passing appraisals, everything. And then like one thing in the debt to income ratio or the interest rates move up. At what point have you seen from your experience that they move up a certain percentage to where it would actually impact the deal that you have going on? So like where should we be, like, okay, if it jumps up a point, a half a basis point?
I hate to say, yeah, I hate to say it. Some of the commitment letters actually have like a max interest rate that the person's approved to. But man, if the deal was that tight where like a 0.5% move was going to deny the loan, that's kind of scary. Like that's not a great job by the original person. And if they had that, you should have locked the damn thing in, right? Like if you're that close, lock it in so that it can't possibly happen. Because we deal with it. I mean, we have had some, we've seen some tight deals come through. If your debt to income ratio is at 44.5 and your max is 45% on that specific deal, well, don't freaking let it float, right? Like you have to lock it right then and there. It can't be, because if you have any variance, you're going to get thrown off. You better have the right real estate taxes. You better have the right insurance numbers so you're estimating them correctly. But yeah, I mean, like, it could be an 1/8% depending on the deal. So there's no like rule to that. It's just, I mean, I hate to say it, like it's more just a bad job by the loan person more than anything to leave it to where that could affect your loan in reality. I hate to say that, but that's the case.
Okay, cool. Thank you.
There's no set number though, because it could be an 1/8%, but I'm shocked at a 0.5%, because that's what, like in the last month, the most we've seen them move is a 0.5%. The damage happened before that. So if a 0.5%, which is on normal deals like $125, $150 a month, kills a deal, then man, that should have been warned up front. We're locked,
Yeah, for sure.
Yep.
Cool. Thank you.
Yep, we had one other question. Are the condo qualifications different if a buyer wants to buy something versus to sublease it? So I don't think we covered like investment properties and second homes and the different reviews needed for that.
Yeah, so if you have 25% down on an investment or a second home, they're still considered a limited review. Unless you're in Florida where they want 30% for whatever reason. But if in New Jersey, in this area, 25%, and you can do a limited review the same way you would on a primary residence. But with a primary residence, you could do that for as little as 10% down. So that's the advantage of primary, you can do 10%, but on a second home investment, 25% down. So we've actually done an investment property condo where there was literally 0 owners in the entire building and all renters, but nobody owned more than one. And we closed an investment there simply because they did 25% down. And when we got the call from the realtor, they were like, obviously this probably doesn't work, right? And then that's how it starts, because they just don't know. Because in the old days, it probably didn't, but now it does. So don't assume like what you knew maybe 20 years ago is the same thing that's there now. They've made a lot of changes to the positive also. Heather, anything you want to add, like just overall, like, some of the litigation stuff we deal with, like what's some of the info that you've gotten that have gotten some of those buildings to the finish line? Like I know you've gotten some emails from people and that's worked, and trying to get as much like info as possible.
Yeah, I did want to note that if there is litigation, we're definitely going to ask for the original complaint. There's going to be two items. So the original complaint and an attorney opinion letter. The attorney opinion letter, what we're looking for is for them obviously to say that they're representing the association, to do a small snippet obviously of what the litigation entails, but to note that it isn't a structural concern and that it's not going to negatively affect association funds. So it's a really big points to make. And in talking to them as because a lot of times they don't want to get into specifics in a letter like that. But it is important to note on those specifics so that it goes with the complaint. And if we do need to get an exception, that'll help us do so. a lot of transition litigation going on in the larger buildings. They are now looking for the repairs to be completed. If not, they want a list of what's been done and what needs to be completed, and a time frame as to when they think it will be. You'll see a lot of that on the budget too, because they have to pay for litigation costs, attorney fees, things of that nature up front before the funds come in from settlement.
A lot of times we're not getting that either. Like, by the way, guys, like, unfortunately, like, they will never list out what's going on or whatever. So we're reading the complaint, figuring out what's real and what sounds real and what sounds like bullshit, and basically just hoping at that point that it doesn't affect our unit. Heather and I have gone as creative as getting inspection reports on units, on buildings where they didn't give us the information. And we got the inspection report on the unit to show the unit had no damage, had no problems, and it was pristine. And gotten, like, we did that for 1000 Avenue at Port Imperial. And because they provided zero, none of what you just asked for, they provided. And so the only way we can get around it, and again, I can't do every product there, but I can do some. And so if somebody wants a rate that's not that bad, but just a little above the market, at least they can close. And the goal is to refinance as soon as the litigation is over anyway. But yeah, I mean, like, we literally got inspections on the units in each case. We closed 4 of them that way in that specific building. And yeah, I mean, it's crazy, but that's what we're doing. So as much as they can put, like, if it affects common areas and not units, that's awesome. Like, they love that. If it's safety, like, if they mention at least that there's nothing unsafe, that's usually a good sign. That's a key thing we're looking for. So if you're going to call me and say, hey, I just picked up a building in the Pearl in Edgewater, I'm going to ask for the same stuff. Like, give me the complaint, like, which I actually have the complaint now. Get me an attorney opinion letter. Get me something. Give me an update on the litigation. Like, where are we? Does it affect everything? Does it affect just one building and not the other one? Because I've heard all these things about that specific place. And then, get me a budget, get me whatever you can, so I can try to make a case why this building is safe and not a problem. And then I'll make the case. Now, I can't do it overnight. Won't take 2 days. Might take a week, might take 10 days, but I'll try to get it. And then once I get it, it's good forever, or at least for the next 4 months. It's good now for everybody. So it's good for loans going forward. We had one the other day at 9060 Palisade where we got something back. It said there was an assessment. Another lender just denied a loan there. Our client was selling the home, and we got the assessment documents. We got what it's for, and we felt comfortable that whatever it was for wasn't scary enough and was going to be done in 2023, that we were comfortable enough to move forward, because to us there was an end date. Like, at some point, it's going to solve itself, because they're going to pay for this stuff and they're going to fix whatever the issue was. And we didn't think there was anything unsafe, and we did it. But another lender didn't think so. They turned it down. And I think that's where who you work with will matter when it comes to condo world more than any other type of loan. Condo co-op, I'll say. If everybody's good on questions, we can wrap it up. I like getting things done quick.
Okay, yeah, no other questions came in.
Yeah. So yeah, that's the world of condo. Obviously, feel free to individually send any of us on the team a text, email, whoever you work with on our team either has access to the information or knows how to get it, and we'll be able to answer you fairly quickly. And if not, I'm not good at a lot of things in life, but I'm good at condo for sure. I can answer you pretty quickly and try to figure things out. We definitely should give a shout out to our sponsor real quick, Mike, or actually Kim, Scott better than anybody. So let's give Scott a shout out. Scott Rutke, president of Concourse Land Transfer, for sponsoring our Uber Eats.
He's actually on. Hey, Scott, thanks for joining.
Oh, hey guys, thanks so much. Obviously, a lot of great information from Baret, and it's great that you guys joined something like that. Not only to, it's not something to just pass the time. I mean, there's a lot of information out there, a lot of good information that not everybody has at their fingertips, and having a good source of information is invaluable, especially when the times get tough. So Baret doing this.
Any title stories or tidbits as far for condos, anything weird or people?
Yeah. So, I mean, obviously, what you guys are talking about, it being warrantable or there being litigation in the actual unit, that's something that, not everybody sort of has at their fingertips when they're looking at properties or selling properties. So just being aware of all of the issues that are out there, obviously lawsuits being the big one, because that's not something that's easily solved. And if you listen to Baret's story, lenders are often capricious with it. So one lender might say that it works. Another lender might say that it doesn't. And knowing which lenders are able to do it is essential, especially for your clients. So having someone like Baret's group being able to sort of, answer the question honestly, hey, listen, this is something we can do. And then also be honest when it's something they can't do is essential for any partnership. And that's something that we strive to do here as well. Getting information out quickly is a lot better than being halfway through a transaction and finding out, whoops, we can't do anything with this property.
Scott's a great resource too. Like if you're looking for a copy of the complaint, I know he'll have access to get it. Obviously, he doesn't want to be doing work for free. So hopefully that's a title that you'll work with him on so that he can get it for you. But he can get a copy of the complaint, any of the amendments. He can pull a master deed if you had to. All that stuff is what title companies are able to do. So we call on that, a lot. And obviously on that case, like we would want them to be able to be the ones to do the title insurance too, so that they get a benefit out of helping you for, just upfront. So that's a great resource for agents.
And most of what I do at this point is educating either borrowers, realtors, attorneys, or lenders about what it is that we do. Title insurance is sort of, and I've said this before for the people who've already been on this call before, title insurance is black magic voodoo. No one's 100% sure what we do. They just know it's expensive. And they, sort of hold their nose talking to most companies and sort of, close their eyes when they see the fee. The litigation surrounding title issues is extremely expensive. So, the protection that we give is different than lending you money or selling you a home or insuring the property as far as homeowners goes. So a lot of what I do is outreach and education. So again, I'm happy to talk to anybody, even if you have a question about a deal that I'm not involved in. Sometimes, we're pretty careful, but there are 711 other Scotts in New Jersey that are telling you that, they're the best title company on earth. And, what really separates us from other places is the education piece. And I really try very hard to do as much outreach as I can, even with deals that we're not involved in, to help people understand what it is that is a problem. And if it's something that, we can't do, we're honest about that too. I mean, there's properties we can't insure for a number of reasons where, maybe we're too careful, maybe we don't see it a different way. Another company can. And conversely, we're able to pick up deals that other guys can't do also by sort of giving a common sense, approach.
Yeah, I was gonna say that's probably where you guys will see the biggest benefit as realtors. If you're about to lose a deal because the title company won't insure over some mortgage the client had from 32 years ago, and they were trying to get a lien release, and they're gonna, you're gonna lose the deal. You'd want to have a Scott on your phone to be able to make a quick call or let us know, and we'll call him for you and say, hey, is this something you'd be willing to look at to take a risk on? Because if they don't deem it as a huge risk, they might say, yeah, you know what, I'm willing to write that policy because we don't see it as a big risk. It's from 32 years ago. We'll figure out how to get it released later, and they might be able to do that. And that could save a huge commission check for you. So just, know that's where title could be, and a realtor could be a big, if something's going down and it's not great, just at least another call to say, hey, these guys will insure it. And that's usually what the attorneys are looking for. They're just looking for someone that's willing to insure it and feel good about the risk. So
that's it. And one thing that you want to make sure with whoever you use, there isn't a lot of, hide the ball. The more information you give every partner that you have, the lender, the title company, whoever it is, the better off they are. There's really no benefit to, something being a secret until the last minute, because then you can't solve it. And nothing can't be solved in my industry. Everything has a solve.
Right.
The problem is it's either money or time. Some of the solves take a lot of time. Some of the solves take a lot of money, but everything is eventually solved. It's just sort of what's everybody's appetite to get that problem rectified as fast as you need it to be rectified.
One day, Scott, you'll have to explain to all of us what the hell a tideland claim is in real life, because I still don't fucking understand it in my lifetime. So,
I think we have to be drinking.
and I know all of us
to
have
go over
gotten
that,
burned
though.
or delayed at one point or another by a goddamn tideland claim in New Jersey, because somehow they have a waterway they still have rights to in this world, which I can't imagine with buildings all over it. But yeah, thank you so much for.
Lisa said she knows all about it. So I think we should have, maybe in the summer when, sometimes in the summer, the lunch and learns are a little light because people are on vacation. Scott, we should get on and just, we can have like a happy hour and, the weirdest questions.
I think if we're going to be talking tideland claim, Kim, we'd have to serve alcohol. There'd be
I just said we should do a happy hour.
30 minutes. We'd have to send bottles of wine to people's home.
Listen,
Scott,
Scott already knows what I say. I saw Todd Malouf's name. Hi, Todd, if you're on here. Your child is adorable. Oh my God, that kid, lock her up. I tell Scott all the time and I tease him. I said, the only thing, you know, a little bit more maybe boring or dry than mortgages is title. But we all make it fun. So
I promise you, it's not boring. I come to my
Yes.
office, see that it's not
Yeah.
a boring. Not a
That,
boring.
that sounds good. We'll get drunk one night and talk about tidelines. That sounds great. All right, thanks everyone for joining us. Really appreciate it. Mike, thanks for